What's up guys, Raymond again with another video. In this one we're going to be analyzing Brenntag, second on the list of German material companies. You can see I got some money invested already. Foreign exchange impact, which means the currency exchange rate, that impacts return on foreign investments. A rise in domestic currency means foreign investments will have lower returns when converted back to local currency. On the other hand, the decline in home currency, our country currency will increase from increased returns of foreign investment. So if you're the foreign exchange impact is basically the the decrease or increase in value of the currency, the home currency, or the currency that you're using. So if the currency that you're using is, for example, the pound, and it's decreased in value, and the stock that you own is in pounds, then the value of your home currency is pound has decreased, then the foreign exchange impact will show a negative balance because it just reflects unrealistically the decrease or increase the value of the currency used for the stock. So back to the main point. Um, so the investment I made has gone up by 3%, which I like. Definitely good, always be positive. Um, let's go to the company details. Of course, as I mentioned in previous videos, I'm going to be passing by the company details because I feel they're very important when it comes to financial analysis. The employees, it's mainly the figures we're looking at, because at the end of the day, the figures are what determine the company's value and future. So the employee level is 17,000, just over 17,000, which is definitely really, really good. The market cap, 12 billion, good, because it's over 10 billion, so it's into the 70 billion euro, 70 billion euro range. P ratio 24. I think is a healthy number. Of course, it would be better to be around the benchmark, which is 10. Revenue is going to be definitely be in the billions. We've got 11 billion, almost 12 billion. The earnings per share, so the amount of euros, single euros that we earn per share or per 81 euros is currently 3.24 euros. So 3.24 euros you earn for what has been earned in the current financial year for each $81.46 euro share. Is that good or not? I definitely don't think it's very good. It's too small the earnings per share, but I've seen worse. So let's continue. The beta is 1.03, which is about 3% over the market average. Dividend yield is under 2, which I don't think is great. But we then again need to check the profit margin. If the profit margin is high, then that could justify the low dividend yield. If the profit margin is low, then that won't really make much sense. Especially if it's the same in the previous years, because then the dividend yield also would be consistently under 2, and that would not be very good for investors. So let's continue on. The income statement suggests, of course, that the profit margin is under 4%. That's almost like a retailer with very low profit margins. That's definitely pretty really bad. It's also been consistent over the past 4 years. Actually, sorry, the past 3 years, excluding the current financial year. They haven't released any information about the current financial year. Let's move on to the next. The balance sheet. The balance sheet suggests that the debt is very high, over 50% of the assets, or over 50%, yeah, over 50% of the assets, which is not great because the interest charges will probably wipe out all of the, not all, but most of the profit margin. Let's look at the cash flow statement, which is the final statement we look at. So the bottom line of the cash flow statement suggests 206 million euros have been added to the company in value at the end of the 2020 financial year. 126 million sorry, 100, yeah, 126 million euros in 2019, in 2018, negative 124. So if you balance that out, the past 3 years, excluding the current financial year, the company's added about 2 million from there, 208 million euros in value to the company, which is definitely very good. So the cash flow statement of this company is probably the best part. All of the other statements, the income statement and balance sheet, show the company to be quite weak, which is not great, but that's what we're here to do. We're here to analyze companies, the strength of companies. So I hope to do that better in the next one, and I'll see you next.